One fund, on point for today, and the expert to talk about it. This is the ETF of the Week. Welcome to the ETF of the Week, where we get the latest take from Tom Lydon, Vice Chairman at VettaFi, where they have a full suite of tools that's going to help you be a better, smarter, savvier investor in exchange-traded funds. If you want to learn more about it, make sure you check out VettaFi.com. Tom Lydon, great to chat with you again.
Great to be back. Thanks, Chuck.
Your ETF of the Week is
the SPDR Gold Shares ETF, ticker symbol GLD.
The GLD, the SPDR Gold Shares ETF. And Tom, anytime we're going to talk gold, well, it begs an important question, which is, why do you love gold right now?
Well, Chuck, it's surprising because people have not been paying attention to gold, but guess what? Gold just hit an all-time high, just crossed above $2,100 an ounce when nobody was looking. A lot of people have felt a little bit of disappointment in commodities and specifically gold in the last year or so. Part of that was China. A lot of people felt a year ago China was going to have a great rebound. And with that, there's a lot of commodity demand that goes on, especially in emerging market countries when they do have rebounds, and it didn't happen. And because it didn't happen, a lot of retail investors sold their gold holdings. There was almost $40 billion that was sold out of gold spot-related ETFs. The good thing, though, is at that same period of time, central banks were grabbing up gold left and right. The accumulation of gold that they had over that period of time, fortunately, surpassed the amount that retailers were selling. And part of that is stabilization, as we've seen higher interest rates across the world. We've seen slippage in economies. Fortunately, that has helped with inflation, especially here in the U.S. But the key thing, Chuck, as we look forward is what's going to happen into the future. Where we are today is most advisors and most investors feel that the Fed is done hiking interest rates. And that's really good for gold because historically, when the Fed is done hiking interest rates and may be on the precipice of actually cutting interest rates, where most investors feel that that's going to happen, historically, that's been a great period of time. At the same time, since gold is very much tied to the dollar, we may see for the first time in an extended period of time, almost since the financial crisis, with major cuts in interest rates that are going to be expected in the next year or so, the dollar may come back to earth. It's had a pretty good run in the last 10 or 15 years. And if that's the case, gold's going to be more affordable for countries outside the U.S. So the moon and the stars seem to be aligning for gold. We're hitting all-time highs, which is fantastic. And also, when traditional 60-40 allocations into stocks and bonds haven't done that great over the last couple of years, a lot of investors are thinking about diversifying.
They certainly are. But at the same time, gold historically has been a good hedge for inflation, but it hasn't proven to be a good hedge for inflation as we've seen inflation come in over the last couple of years. Is this also a little bit of, hey, let's hedge away some of the geopolitical risk and gold will help do that?
Well, regardless if it's geopolitical or it's economic behavior or it's market volatility, gold historically has provided some dampering in portfolio volatility, which is good. It should do that. But people don't want to invest in something just so they don't have a lot of bumps. They want to invest in something so they actually make money. And gold has done that over time, hence this new all-time high. I think that's really, really key and critical. But you point out during times of inflation, gold historically has done really, really well. It did okay. I mean, the last couple of years, it was up about 12%, where when you look at equity markets and the Barclays Ag, the bond market, actually was negative. So that it did what it's supposed to do, but not to the extent that most people would expect. Now we've got another thing that's coming. A lot of people are looking at crypto. They're looking at crypto as possibly being the new gold, and we're on the edge of maybe getting approval from the SEC for the first wave of spot Bitcoin ETFs. That means that, like GLD, that actually owns gold in vaults, that these ETFs would actually own Bitcoin as opposed to Bitcoin futures. If that's coming, we might see a new generation start to diversify. Maybe they'll have Bitcoin instead of gold, or some gold and some Bitcoin. It's going to be very interesting to see what comes. And the SEC's deadline for this is January 11th, where they need to make a decision.
That said, obviously, a Bitcoin fund and a spot Bitcoin fund, it's going to be really interesting to watch the construction. But gold, there's a lot of different types of gold ETFs. There's a lot of different gold ETFs. Now, the GLD is not a miners fund, et cetera. But when you're talking about this as the ETF of the week, if somebody prefers the AUM or the OUNZ or some of the other things where, maybe this is better, maybe that one you could redeem in gold, whatever it might be, do you care so much about construction when you're making this call on gold? Or is this gold ETFs, but physical gold, not mining gold?
Yeah, miners and physical gold don't always correlate. There's a lot of good things to be said about miners. However, it's more expensive than ever to get an ounce of gold out of the ground. That it operates differently. But take a look at it, because there are periods of time when the price of gold goes up where you can actually make more in miners, as miners are trying to pull as much as they can out of the ground, get paid more for it. It's not the same. And there are other spot gold ETFs. Some actually have an expense ratio that's less. GLD was the first. It's the bellwether for the industry. That's why I selected it as ETF of the week.
And is it a 200-day moving average play?
It absolutely can be, Chuck. And at the same time, where's the money come from, which I know is your next question? Everybody's got a slew of cash that's on the sidelines. Through this volatility that we've seen in the last couple of years, most folks have taken something off the table. And you have new money that's available. So if you want to institute a 200-day average trend following strategy, now's a pretty good time to do it.
It's the SPDR Gold Shares, the GLD. It's the ETF of the week from Tom Lydon, proving, again, that, all good advice that glitters may not be gold, but sometimes it's golden, like today. Tom, great stuff. Thanks for joining me.
Thanks, Chuck.
The ETF of the week is a joint production between VettaFi and Moneylife with Chuck Jaffe. And yeah, that's me. I am Chuck Jaffe, and you can learn all about my hour-long weekday show by going to MoneyLifeShow.com or by searching on your favorite podcast app. To learn all about investing in exchange-traded funds, to get tools that will make you a better investor, be sure to check out VettaFi.com. They're on Twitter or X at Vetta_Fi. And Tom Lydon, their vice chairman and my guest, he's on Twitter or X too. He's at Tom Lydon. The ETF of the week is here for you every Thursday. Make sure you don't miss one by following along on your favorite podcast app. And until next week, happy investing, everybody.